Hello, we are Group 1 and we're presenting on the outlook for Australia over the second half of 2026, along with what should the policymakers do in response to everything that's happening to the global economy. Before we dive in, I would like to briefly introduce our team and lay out how we will tackle the questions. So we are a team of 5. I'm Georgian and I will set the scene, and then the presentation would be continued by Mansi, Dikshita, Ayush, and then finished by Sandesh. Each of my colleagues will then take on one major piece of the analysis, and we'll be ending the slides with our cash rate forecast and final takeaways. To discuss the questions given, we split the work into 3 parts, and you will see this structure running through the rest of the presentation. The first part will be discussing on how these global shocks feed through the Australia's core macro variables, which is the GDP, employment prices, the balance of payments, and as well as the exchange rate. The second part will look at the policy response from both the Reserve Bank of Australia and the federal government. And then the last part will bring those two parts together, and we will produce our forecast for the cash rate between June and November. Firstly, I will explain about the context of the situation as well as the impact. There are currently 3 shocks that motivates this current situation. First, the President of USA, Trump, has imposed tariffs on many of Australia's major trading partners. Other countries have also followed as a response to it. This causes uncertainties and shifts in the trading system. Then the war between major countries like US, Israel, and Iran is restricting the production and movement of energy as well as the key commodities, which results in resource shortages and rises of resource prices. Lastly, the major central banks are out of sync. So the US Federal Reserve delivered 3 cuts in late 2025 and is still easing, while the Reserve Bank of Australia actually raised the cash rate in both February and March of this year, even after cutting it in 2025. These are the details on how Australia enters the second half of 2026, where the real GDP rose about 0.8% in December quarter of 2025 and around 2.6% over the year, which is the strongest annual growth since early 2023. Inflation is sitting at the top of Reserve Bank's 2 to 3% target band, with cost push pressures from tariffs and energy actually re-accelerating rather than easing. The unemployment rate is still close to 4%, which is a near most estimates of full employment. So as a starting point, we have a strong demand and then supply being squeezed, and a central bank that has already chosen to tighten rather than ease. This will be the flow of our presentation, and these are the core identities that will be used for the rest of the presentation. I will let Mansi to proceed with the further discussion.
Thanks, Georgian. I will explain how the global shocks we have discussed are affecting spending in Australia and how that flows through GDP. Starting with consumption, it mainly depends on income, interest rate, consumer confidence, wealth, and access to credit. In the half of 2026, most of these factors are mostly negatively. The Reserve Bank interest increases earlier in this year, with the cash rate around the 4.35%, making borrowing more expensive. This reduces spending and especially on housing and durable goods. Consumer confidence has also weakened due to global instability and US tariffs, so households are more becoming more cautious and cutting back on spending. We are also seeing a negative wealth effect because housing and share markets have been unstable, making people feel less financial secure. On the top of that, banks are tightening lending standards, making credit harder to access. While disposable income remains mostly unchanged, as a result, consumption is slowing and reducing aggregate expenditure. Moving to investment, it depends on interest rate, expected profit, and business conditions. With interest rates still high, borrowing is more expensive for firm, so fewer investment projects remain profitable. This raises the hurdle rate, only high return projects moves forward. Expected profits are also weaker because of the tariffs and the global instability, making businesses more cautious about spending. Rising oil prices linked to Middle East conflicts are also increasing the production costs, especially for the trade exposed industries. Since capacity utilization is around normal level and tax setting haven't changed, firms have little incentive to expand. As a result, investment is declining. When both consumption and investment fall, aggregate expenditure decreases. In the 45-degree diagram, this shows by the AE curve shifting downwards, leading to a lower equilibrium level of outcome. This caused the GDP to fall below the potential out, creating a recessionary gap. The multiplier effect makes this larger, although Australia's high import reduces some of the impact through leakage. This reflects the current macroeconomical conditions where demand side weakness is slowing down the economic growth. Overall, weaker consumption and investment are reducing the aggregate expenditure and slowing down Australia's economic growth. Now I will hand over to Dikshita.
Thank you, Mansi. Building on the demand side discussion, I'll now bring in the supply side using the aggregate demand and aggregate supply framework. On this slide, we're working with three key curves: aggregate demand, short run aggregate supply, and long run aggregate supply, which represents potential output, that is the YP. On the left panel, we see a negative demand shock, higher real interest rates, weaker consumer confidence, and softening investment shift aggregate demand from AD to AD1. In isolation, this would reduce output and lower the price level, creating a recessionary gap. However, in Australia's case, this effect is relatively contained. The reason is that in Australia's export sector, particularly commodities like iron ore and LNG, continues to benefit from stable structural demand, especially from Asia. So while demand is clearly softening, it's not collapsing. This leftward shift in AD is moderate rather than severe. And looking at the right panel, we have a more critical part of the story, that is the supply side shock. Rising global tensions, tariffs, and disruptions linked to the Middle East conflict have increased the input costs, particularly energy, shipping, and imported intermediate goods. This shifts the short term aggregate supply from SAS to SAS1. On its own, this reduces output while increasing the price level, which is the classic cost push inflation or stagflation scenario. Combining both of these, the overall outcome becomes clearer. Both aggregate demand and aggregate supply shift left. But the key insight is that the supply side shock is doing at least as much work and likely more than the demand side shock. This is because Australia's export demand remains relatively resilient, limiting the fall in output while rising costs continue to push prices upward. Moving on, the net effect on the Australian economy. So this slide represents three possible macroeconomic positions: full employment, recessionary gap, and an inflationary gap. Given the combined shocks we've just analyzed, Australia is unlikely to move into a deep recessionary gap. Instead, the economy is expected to operate slightly below potential output, meaning any output gap is relatively small. Now let's look at the core insight, that is the stagflation pressure. Our overall assessment is that the economy is moving toward a mild stagflation scenario. Output growth is soft but not collapsing, while inflation remains relatively firm due to ongoing cost pressures. Um, Breaking it down, we can look at the key outcomes, that is, that the supply side shock dominates, meaning price pressures persist despite weaker demand. Output remains close to potential, so this is not like a classic recession. And inflation is likely to sit toward the upper end of the RBA's 2 to 3% target band, particularly because of the imported cost pressures. And unemployment might rise slightly, but labor market conditions remain relatively tight by the standards. And on the external side, the current account surplus may narrow modestly, while the Australian dollar is expected to remain relatively stable or slightly weaker, helping offset some external pressures. The key takeaway here is that this is not a straightforward demand driven slowdown. Instead, it represents a policy trade off. Stimulating the economy risks worsening inflation, while controlling inflation risks slowing growth further. With that macroeconomic picture in mind, we now shift our focus to the external sector, specifically the balance of payments, exchange rate dynamics, and the role of fiscal policy in responding to these challenges. And now I'll be handing it over to my teammate Ayush.
Thank you, Dikshita, for a wonderful presentation. I will now explain the balance of payments, links to Australian dollar, and then briefly discuss the fiscal policy response. The balance of payments shows how the money flows in and out of Australia. So, when we talk about the Australian dollar, the key question is Australia attracting enough export income and foreign investment to support the Australian dollar? Starting with the current account, Australia is still supported by major exports such as iron ore, LNG, coal, and agricultural goods. These exports are important because demand from Asia continues to bring income into Australia. When foreign buyers purchase Australian goods, demand for the Australian dollar increases, which supports the currency. But there is another side of the story. If oil prices and shipping costs rise, which is currently happening due to the ongoing war in Middle East, Australia's import bill become more expensive. This can weaken the current account and put downward pressure on Australian dollar. Now looking at the capital and financial account, interest rate hike can attract the international investor to Australian bond sales and asset. This creates an extra demand for Australian dollar. However, the bigger risk is global uncertainty. In a risk of environment, investors usually move the money into safer currencies like the US dollar or other commodities, which can be a gold. You can see on the graph on the right hand side, the red shift is the key point here. Demand for Australian dollar falls, while the supply may increase the investor move funds overseas. As a result, the exchange rate move from the original position E0 to the new position E1, meaning the Australian dollar depreciates. So here our view is that Australian dollar is likely to remain stable or slightly firmer if commodity exports and capital inflows remain strong. But under a prolonged conflict or global recession, downward pressure will increase, especially through weaker China demand, higher import costs, and risks of capital outflows. So, moving on to the fiscal policy, we can see three types of fiscal response. The first one is automatic stabilizers, such as unemployment benefits and lower tax collection can support the economy naturally when growth slows. The second, the government can use targeted spending. For instance, or in, uh, they can spend on infrastructure, energy, defense, or other things. The third one is tax measures. Maybe they can cut down taxes on fuel prices when the fuel prices rise. But here, our recommendation is to use the fiscal policy carefully. As shown on the graph on the left bottom hand corner, we can see the aggregate demand switch to the right, to the new position. In a normalization, this can support output and employment. However, the current risk is closer to stagflation, where growth slows but the inflation remains high due to supply shocks like oil prices and shipping costs. So, broad stimulus could actually make the inflation worse. That is why the fiscal policy should act as a shock absorber, not the main driver of demand. It should be targeted temporarily and focus on areas that genuinely need support. To address the situation further, we need to go to the monetary policy and response. To explain that, I would like to hand over to my colleague Sandesh. Thank you.
Monetary policy and what it means for our rate outlook. The Reserve Bank of Australia operates within three clear objectives: price stability, full employment, and overall economic welfare. In practice, that means one thing: keeping inflation within the 2 to 3% target band using the cash rate. Now, the important question is, how does that decision impact the economy? It works through a chain. Cash rate changes, market interest rates, borrowing and spending. which affects consumption, investment, and net exports, which then sets aggregate demand and ultimately drives output and inflation. But here's the insight that matters most: timing. Monetary policy is not immediate. Outputs responds with roughly a 1 year lag. Inflation closer to 2. The tightening we saw earlier in 2026 that is still working through the system today. What does the current environment look like? Let's have a look onto that. Australia in the second half of 2026 is facing stagflation. Growth is slowing, but inflation remains persistent. On the supply side, we have seen a left-out shift in short-term aggregate supply, driven by higher energy prices, tariffs, and supply chain adjustments. In simple terms, costs have increased. At the same time, demand has held up better than expected, supported by strong commodity exports like iron ore, LNG, and agriculture. That combination creates a policy constraint. If the bank cuts rates, it stimulates demand, but supply remains restricted, which pushes inflation higher. So, easing policy doesn't solve the problem. It actually conflicts with the inflation target. What does this mean for the path of the rates? The cash rate enters June at 4.35% following the March increase. Our base case and the most likely path is measured a hold in June, a hold in June and July. One final 25 basis point hike in August to 4.60% and then a hold through November. The logic is forward-looking. Inflation pressures, particularly from imported costs, are expected to appear in the June CPI. So the bank acts early, not because conditions have already worsened, but to ensure expectations remain anchored. Now, there are alternative scenarios. If inflation proves more persistent, especially through wages, we could see a more aggressive response, with rates rising to around 4.85%. If demand weakens more sharply and commodity price eases, the bank may hold a 4.35% throughout. But across all scenarios, one point is clear. Rate cuts are not part of the 2026 story. To conclude, Australia is facing stagflation, driven by supply-side cost pressures alongside resilient demand. This creates a constrained policy environment. Fiscal policy risks adding to inflation, and we don't want that. The government doesn't want to add the inflation. So the burden sits with monetary policy. Our central expectation is one final hike to 4.60% in August, followed by a period of stability as earlier tightening continues to take effect. And in this environment, the priority is clear: price stability over short-term growth. This is what the government should respond, and these are the references. Thank you.